More on the markets and Fed decision. Let's bring in Savita Subramanian, the head of U.S. Equity and Quantitative Strategy at Bank of America Securities. Savita, great to have you with us.
Great to be here.
So given what he said today, given some of the mega cap earnings that we're getting after the bell, what do you think? Is this
What are we making of all of this? Well, today felt like a really boring day until after hours, right? So I think it's still a lot of the attention is still focused on tech, AI. Meanwhile, the market has been broadening. We've seen the S&P equal weighted outperform the cap-weighted benchmark. We've seen small caps come back. So I think there's a lot of interesting stuff going on that doesn't get a lot of airtime. In terms of how to position for the year, I think it's important that this is a midterm election year because, where we are is an environment where we need to, kind of the current administration wants to really, focus on affordability. The rhetoric is changing a little bit from just trade policy to affordability to domestic issues here at home. And I think that could actually be really positive for areas that have struggled, like consumer staples. So consumer staples is our most out of consensus bullish overweight. And nobody likes it. And we get questions every day, especially after, the most recent announcement from Amazon on grocers. I think it's an interesting sector that's pricing in a lot of bad news. And if you do see that lower income consumer cohort that has been struggling the most against inflation get a lifeline. And what we're hearing now from policymakers is a lot of good things in the midst. I think that could be a really interesting sector to
I think
look
you're
into.
right. I think it is out of consensus, and that's fascinating. I think it's particularly coincident and fascinating that you're on tonight when Steve just gets off saying we upgraded the economy, we seemingly have upgraded EPS outlook, and you think those two ingredients for most people are not good for the stock market.
Well,
Talk about that.
I think that the stock market right now is more likely to be bolstered by capex and manufacturing than consumption. And I worry a little bit about consumption because when you think about the biggest contributor to consumption growth over the last 30, 40 years, it's been white-collar professional services, 25 to 45-year-olds, basically us when we graduated from college. And that cohort is not getting jobs. Today, there has been a kind of a big pause in terms of hiring grads. So college grads are going back to grad school, incurring more debt, and still not getting jobs. So I think that's something to keep an eye on. Maybe it's nothing to write home about right now, but we're seeing it, we're seeing it everywhere. You're seeing just this sort of air pocket in terms of demand for new skilled labor because AI can do a lot of that stuff.
Yep.
So I think that's
I'm sorry,
risk.
I was going to say, if memory serves, which it typically does, it was June of 2023, the S&P was 4,300. You were the most bullish you had been in a decade.
Yeah.
And now look at where we are now. But your price targets suggest
not so
bullish anymore.
Yeah, I'm glad you brought that up. I mean, back then, there were a lot of things going right for the market. It was cheaper. There was, very little debt, no capital raises. You didn't see a lot of, interest in equities. It was still like we're heading into a recession. Everything is awful. Today, the economy's booming. Everything's fine. You want to be long stocks and crypto and everything else out there. So I feel like sentiment has really done a big 180. And Michael, you'll appreciate this. We have one model at BofA that we've been running since Rich Bernstein started it back in the 80s, and it is still telling us that sentiment on stocks is not necessarily euphoric. So I think there could be upside in a lot of areas of the market, but sentiment on AI and tech feels pretty darn euphoric to me at this point.
Yeah. I mean, we agree, obviously, Savita, with sort of the broadening of the market. I mean, much of our framework is the same, of course. What happens if, you have the Atlanta Fed right now running at, 8% essentially nominal GDP, 5% real. You've got earnings growth that is accelerating. You've got inflation near 2%. What happens if the Fed just doesn't hike this year? What happens if rates go back up? Doesn't cut this year. What if the 10-year goes back up to 5%? What does that do to sort of the outlook? Is that better for the outlook, suggestive of higher growth, or is it worse for the outlook because of?
I think it's better for broadening, and I would stick to that broadening call. We thought broadening was going to happen last year. It didn't. Mea culpa. I think April 2nd kind of screwed that up. But this year we've got CapEx kind of firmly in place. We know tax policy. Rates can move to 5. I don't see that as anathema for the stock market.
Nice word.
Yeah,
Sorry,
that's
we
an
like
SAT
we're
word.
wordsmiths here. Sorry, keep going.
That's an SAT word that I just snuck in there.
Sure.
But I think that we could have a year where tech doesn't do as well. And I think that rates rising on the long end is most detrimental to these mega cap growth companies, because back in 2023, what they did to deal with higher rates and less of a multiple was they cut CapEx, cut costs, fired a bunch of people, did a huge buyback. Today, can they really cut CapEx? I wonder. We're in this arms race on AI. So I think that's where you get to the problems. But on the broader market, we could still see room for a lot of upside and multiple expansion, as long as the reasons are cyclical growth.